Today, weaker markets, weird data. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, US markets started September on a weak note after the Monday holiday, extending a slide that started at the end of August as hawkish comments from Fed policymakers and data signalling US economic momentum raised fears of aggressive interest rate hikes. The S&P 500 is down nearly 18% so far this year, while the Nasdaq has shed over 26% as rising interest rates hurt megacap technology and growth stocks. Among the major S&P sectors, energy and communication services were among the worst performers, while defensive utilities and real estate rose. So, at the end of the day, the S&P 500 was down 0.41% to 3,908. The Nasdaq Composite lost 0.74% to 11,544, and the Dow Jones Industrial Average fell 0.55% to 31,145. The tech-heavy Nasdaq suffered its seventh consecutive day of losses, and that's the longest losing streak since November 2016. Rate-sensitive shares of Amazon.com and Microsoft both fell about 1% as benchmark US Treasury yields rose to their highest levels since June. The 10-year lifted to 3.351, while the 2-year was up to 3.5071, still inverted. Apple, which will launch new iPhones next Wednesday, also lost ground. The volatility index touched a 2-month high of 2780 before settling back to 2691. Now, central banks, of course, are being data dependent, meaning their rapid rate lifting cycle decisions are being determined by the emerging data stream. And overnight, the Institute of Supply Management's Services Index unexpectedly improved to 56.9 last month, while S&P's global final August gauge of business activity dropped to 43.7. In both surveys, a reading of 50 is the dividing line between expansion and contraction. In fact, the last time the ISM measure exceeded the S&P Global gauge by that much was during the depths of the pandemic back in April 2020. The most striking divergence in these two prominent gauges of US services activity since April 2020 can probably be traced in large part to what types of companies were surveyed and differences in methodology. Overall, while our tracking models suggest that the risks of recession over the next year or so are rising, we still think the economy is more likely to see a period of below-trend growth rather than outright contraction, said Andrew Hunter, senior US economist at Capital Economics. In fact, on the face of it, the ISM report does cover a greater number of industries than its counterpart. The S&P Global survey excludes retail and wholesale trade, construction, mining, utilities, agriculture, and various government administrations. But ISM does include all those industries. And moreover, the ISM gauge is a composite reading based on 4 equal-weighted indices that include business activity, new orders, employment, and supply deliveries. The group survey is actually sent to its Services Business Survey Committee members, who are asked to report on just their year's operations. Now, on the other hand, the S&P Global measure doesn't aggregate sub-indices and instead calls its business activity gauge the primary measure of overall output in the services economy. It is most useful to look at the signal from a broad set of survey indicators together rather than focus on any one individual survey as being the correct gauge of the economy, Daniel Silver, economist at JP Morgan, said. And we should also keep in mind that whilst the ISM survey data has looked stronger than the PMI data lately, the ISM data still shows a clear cooling in recent months relative to readings from late last year, Silver said. So Wall Street's main indices closed lower on Tuesday, the first session after the US Labor Day holiday and summer vacations, as traders assessed fresh economic data in volatile trading. The stronger than expected reading on the US service sector fueled expectations that the Federal Reserve will keep raising interest rates to tame inflation. The Fed has relegated us to being very data dependent. So every piece of information that comes out, investors are going to look at not only at the absolute level, but also try to infer what it may mean for when the Fed meets, said Carol Shillef, Deputy Chief Investment Officer at BMO Family Office. One of the things that is disconcerting to investors is that there's really little to propel markets either solidly down or solidly up, she added. And concerns over the supply of energy to Europe and how COVID-19 lockdowns will impact China's economy also drove markets down on Tuesday, said Sean Crooks, head of trading strategies at TD Ameritrade. A lot of uncertainty and volatility is not coming from the US, it's actually coming from overseas. Indeed, the Dutch gas futures price reacted to the closure of the Nord Stream gas flow from Russia, rising significantly higher before easing, but is still in expensive territory. And crude prices were back to where they were on Friday, in the red, as the cut, equivalent to 0.1% of global daily demand, would do very little for the market, which is actually much more worried about the impending US September rate hike and China's COVID lockdowns. The dollar index, which pits the greenback against the euro and 5 other major currencies, hit a 20-year high of 110.54 on Tuesday on continuous bets that the relatively strong US jobs reports for August could embolden the Federal Reserve in carrying out its third straight 75 basis point rate hike on September the 21st. A runaway dollar basically makes commodity prices in the US unit, including crude, costlier when acquired with other currencies. And in China, most of the 21.2 million residents of Chengdu City faced extended curbs on their movements, even as the estimated 18 million in the tech hub Shenzhen saw an easing of lockdown conditions imposed since Monday. New York traded West Texas Intermediate, the benchmark for US crude, settled Tuesday's trade down at 86.88 per barrel, just a penny from Friday. Last week, WTI fell 6.7%, and Brent, the London traded global benchmark for oil, settled at 92.83, down 2.91 or 3.04% from Friday. And for last week, Brent also lost 6.4%. WTI reached a session high of 90.37 on Monday, while Brent rose to 96.99. That rally came in a knee-jerk reaction to OPEC Plus's announcement that it would cut output by 100,000 barrels per day in October. The market's upside seemed stretched by momentum rather than clear thinking amid thinner than usual holiday conditions. But by the start of Tuesday's trading in Asia, the market began rolling back the previous day's gains as traders realized that OPEC Plus was merely planning to roll back on paper the same 100,000 barrels per day reduction increase that it announced a month earlier. The 23-nation OPEC Plus comprises the original 30 members of the Saudi-led Organization of Petroleum Exporting Countries and 10 other oil-producing allies steered by Russia. By Tuesday's session, OPEC Plus's production cut was branded as symbolic, precisely what it was, as the market caught up with the alliance's game. It was also clear that the move had been forced by elements within OPEC Plus hanging onto Saudi Arabia's hint from 2 weeks ago that a reduction of some sort was necessary to restore some of the market's bullish psyche after a 30% price drop from its March highs. Noah Barrett, research analyst for energy and utilities at Janus Henderson Investors, said the cut indicates that OPEC Plus is watching demand very closely and is trying to manage supply to keep a floor on oil prices. But be that as it may, the reality is that with the end of the US peak summer driving period, consumption numbers for crude as well as fuel products could stall despite robust demand at pre-pandemic highs. So coming back to the Fed, traders see a 72% chance of a third consecutive 75 basis point rate hike at the Fed's policy meeting later this month, according to CME's FedWatch tool. So the focus will be on Fed Chair Jerome Powell's speech on Thursday, as well as US consumer price data out next week for clues on the path of monetary policy. But then, of course, data signals can be misleading. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.